Today we are with a company which is manufacturing a healthier alternative to refined / palm oil. They have their own brand called yes, with you must have seen it on Blinkit, Zepto, Instamart, etc.
MD Naturals Limited is a 650 crore market cap company whose business can be divided into three segments. Oil commodity manufacturing, which includes rice bran and olive oil. Consumer division, which includes instant mixes, wheat-based pastas, popcorns and peanut butter. And the ethanol division, India imports 55% of its annual edible oil needs, and the market is expanding at an exponential rate, especially as India becomes health conscious. They have also ventured into ethanol. Today we discuss the supply chain of edible oil, scope of ethanol blending, and financial status of the company books.
We work on high gross margins, and therefore the overall fluctuation percentage is low. And the third is we have a hedged product portfolio. So we have different blends of olive oil, we have pure olive oils as well. So depending on inflation in any particular subcategory, we are able to hedge it with another product that we have. So we are fully backward integrated in most of the core categories that we are in. So for example, like you said, olive oil, we are actually the only company refining olive oil in India. The different grains or molasses, they give you a different yield in terms of ethanol. For example, rice will have the highest, which gives about 450 liters per ton, followed by maize at about 380 liters per ton. Sugarcane juice will give you about 310, followed by B heavy molasses 290 and 225 for C heavy molasses.
So there has been a lot of buzz around ethanol targets of India, especially considering the surge in profits that Nitin Gadkari's son has reported recently.
Well, I wouldn't like to comment on our Honourable Minister's personal affairs and companies.
Hi, if I were to ask you a very simple question, that is, what all products come to your mind when I say the word health consciousness? You'd probably answer with protein bars, zero sugar ice creams, zero maida bread, and most importantly, no palm oil. Today we are with a company which is manufacturing a healthier alternative to refined / palm oil, that is olive oil. They have their own brand called Olive, yes, with a double E, and you must have seen it on Blinkit, Zepto, Instamart, etc. They are clocking a revenue of 650 crores annually. Do you know India imports 55% of its annual edible oil needs? We have with us Akshay Modi, MD at MD Naturals Limited, to discuss everything about the industry, the sector, and where does he see MD Natural going from here. Thank you for joining us today, sir.
Thank you, Achal. Thanks for having me on this podcast.
Sir, we would like to start the podcast with your educational background first. Where have you done your education from, and how has that shaped your career as a promoter at MD Naturals Limited?
Sure. Well, I grew up in a small town in UP called Pilibhit, and I went to a boarding school, namely the Doon School in Dehradun, followed by engineering at University of Leeds in the UK. And I think primarily the values that my journey instilled in me was that of hunger for growth and passion for innovation, and at the same time upholding core values of integrity and accountability.
You're a second generation entrepreneur, right?
Correct.
Yeah. So we would like to, before discussing the supply chain or business model, I would like to touch upon your product mix first. When I was doing my research, the product mix is a little airy, I would say. You have popcorns and you have traditional business called refined and olive oil. You have instant mixes and peanut butters, pasta. So how come you introduce these products, and if you could break down all the product mixes in the simplest language possible?
Well, if you dial back a bit and look at the segmental, the three different segments that we have in the company. One is the consumer division, which is the FMCG business. Second is our bulk oil business. And the third is our ethanol division. Okay. So these are the three core divisions in the company. And then, of course, within the consumer division, we have different product lines such as edible oils and snack foods.
Okay.
So, so if you want a revenue breakup of these three segments, we're doing roughly 179 crores we did last financial year in the consumer business, and roughly 136 crores in the bulk oil business, and close to 326 crores from the ethanol division, totaling to about 660 crores.
So what was the thought process behind introducing these products like popcorns, instant mixes, because these have nothing to do with olive oil or refined oil?
Yes, of course. I mean, when we're doing innovation for the company, working on innovation for the company, we look at things such as distribution salience and consumer salience. So there are three vectors that we look at. One is a brand salience, Second is consumer and distribution salience.
Okay.
So then we look at products which of these at least two out of three saliencies that the product mix fits into.
So are these more value-added categories?
Yes, absolutely. They are more value added in terms of more margin accretive for us.
Okay, and do you see this segment expanding for you? Because I think the olive oil or the refined oil division is in saturation stage.
Well, absolutely. We intend to expand these other portfolios for us as well. And we do that one category at a time. So this year we've taken a big leap on our pasta portfolio, which is actually under Olive Kitchen sub-brand of Olive itself.
Stop. Before you invest another rupee, ask yourself one simple question. When was the last time you heard the real story behind your investments? We are Green Portfolio, an asset management company managing around 1000 plus crores. We are a team of 40 plus professionals, including CAs and CFAs. Aside from tracking companies, we are inside the room with the management and on factory visits asking very tough questions. With Green Sharks, what we bring you is the direct conversation with the management of listed companies. We are building not just another channel, but a community where we are giving you a chance to ask your questions indirectly to the management of listed companies. You can join the community with the link given in the description below. We are your research team, getting you in the room of the companies you want to invest in. So welcome to Green Sharks, an investor's edge in stock research. Okay, so now coming to the most important question, explain us your supply chain. Like, where do you source? Let's take the example of olive oil only. Where do you source the raw material from? Where do you refine it? How does it finally reach to the consumer?
Sure. So we are fully backward integrated in most of the core categories that we're in. So for example, like you said, olive oil, we are actually the only company refining olive oil in India. So we've got the technology to process it here. And we did a lot of R&D and hard work to get that technology to India from different parts of the Mediterranean region. And since we are end to end, we process the oil and we bottle it, we package it, and we have our own brands that go to the end consumer. So in most of the categories that we operate in, we are end to end. And similarly, raw material sourcing for each of the segments varies based on its own complexities.
So if I take an example of olive oil, where do you source the raw material from?
The raw material for olive oil comes from the Mediterranean region. Primarily, you could say Spain, Tunisia, Morocco. Depends on where the crop is good in which year. And we are not restricted to one country alone. So we have that option to source from wherever the crop is good in a particular year.
So we are seeing supply chain bottlenecks, especially considering the geopolitical situation that we are witnessing in these times today. So are you seeing any impact?
Well, we are not exposed to the US market as of now. So effectively, for most of our exports, we are looking at export of our protein byproducts from both segments. And that is actually an advantage for us because the countries other than India are also facing the same wrath of the US tariffs, not just India. So, and a lot of these countries are also applying reciprocal tariffs to the US. So effectively what that does is it puts India in an advantageous position to export to other markets. And I think that will happen to export sectors within India as well.
So raw material price fluctuation is the primary driver in agribusiness. So how do you mitigate that risk? Do you have your agreements logged in when you procure the raw materials from these countries?
So there are two aspects to that. One is one cannot do very long-term contracts. Number one. Number two.
Because in the end, these are commodities only.
Exactly. Number two, I think the way we work is we work on high value addition in every product category, where we work on high gross margins, and therefore the overall fluctuation percentage is low as far as our realization is concerned. And the third is we have a hedged product portfolio. So we have different blends of olive oil, we have pure olive oils as well. So depending on inflation in any particular subcategory, we are able to hedge it with another product that we have. So consumers have the option of choosing from different products within the portfolio.
Okay, so obviously olive oil is made from olives and that you're sourcing from different countries, but I think that is not the case with rice bran oil because that is made from rice grains and you must be sourcing it from India itself, right? So for all the other categories, that is popcorns, Instamixes, do you have your own manufacturing plants?
Only for oil we have our own plant, and for popcorn it's a leased plant.
Contract manufacturing?
It's leased, so we've leased the plant to ourselves. And all the other product categories are contract manufacturing.
Okay, so what is the strategy behind going asset light in some of the models and asset heavy in the other, like ethanol?
Well, I mean, it's basic, right? So wherever we have some technological innovation, like for example, in olive oil, we are the only producers. We got into manufacturing. Similarly, we have traditional manufacturing facilities for rice bran oil. We have had them for a while. And ethanol, of course, is very, very infrastructure heavy, and it came with some government incentives, such as interest subvention, etc. So those we have invested in the back end in manufacturing facilities, and other product categories where we do marginal, differentiation in products, and as well as work on the branding and marketing. There we do outsourcing.
Okay, so you, as I told the audience before, that you have a brand called Olive and you have a brand called Peepo too. From a marketing perspective, what is the strategy behind launching a different brand name for different products?
Well, we don't look at it product wise particularly. It's more category specific. So, for example, Olive is a health and wellness brand. So, all the products that come under the health and wellness category, they will come under Olive or sub brands of Olive. Like, for example, our pasta portfolio is again very healthy. It's a no maida pasta range, including a product which is multigrain pasta. So, that comes under Olive Kitchen. Now, Peepo is our brand for taste and convenience category.
So you have divided the brands into the categories they fall in.
Correct. So there's health category, there's taste and convenience category, and the third is our sweet and sugary category, which is the instant mixes.
Okay, so coming to your ethanol projects, what are your plans for it? What is your current capacity utilization, and what is the capacity that you are targeting?
Sure. So currently we are operating 130 kiloliters per day capacity, and that's running at roughly almost 100% capacity utilization. And we have all the orders from the OMCs as well for that.
So, how does ethanol manufacturing really work? So, do you source the grains, split it into oil and ethanol? So, how does the manufacturing?
Sure, I'll touch upon that. So, I'll just complete my thing about the capacities. So, 130 is what we're already running, and we are adding another 180. So, we are more than doubling the capacity. We'll go up to this should be come online in Q3 of this financial year. So, in another 2 or 3 months, we will start the trials. So, this totals to about 310 KL per day capacity. And as far as your next question goes on the grains, how grain ethanol works is basically we get the grains, which are essentially starch containing compounds, commodities, and then the starch is converted into ethanol through a process called liquefaction and fermentation and distillation, and the byproduct is actually protein. So they are protein animal feeds primarily. And then you get in the case of maize, you get a small quantity of maize oil as well. Sometimes it can be removed and sold separately, but in some cases it is sold with the protein meal itself because it has a value for the farmer.
So we have been hearing a lot about ethanol. Some companies are doing corn-based ethanol, some companies are doing sugar-based ethanol, and you are doing rice grain-based ethanol. What is the difference between all of these?
So maize, rice or any other grain, it is all clubbed under grain-based ethanol. And the sugar ethanol comes from 3 raw materials, either directly the sugarcane juice or B-heavy or C-heavy molasses. And basically all the different grains or molasses, they give you a different yield in terms of ethanol. So for example, rice will have the highest, which gives about 450 liters per ton, followed by maize at about 380 liters per ton. And sugarcane juice will give you about 310, followed by B-heavy molasses 290 and 225 for C-heavy molasses.
So if I were to set up my own ethanol manufacturing plant, so how does the government subsidy structure work here? Because government has been focusing a lot on E20 blended petrol using ethanol. So if you could explain us giving us a hypothetical example, like how much loan do you have to take, or what milestones do you have to achieve to avail the government subsidy?
Well, the main subsidy that the government gave was the 50% interest subvention on your term loan.
Okay, meaning if you could break down that into simpler terms.
For example, if I take a term loan of 100 crores, and the bank charges 10% interest on that, then 50% of that, which is 5%, is paid by the central government. And that is structured through NABARD or And but that window has now closed. So essentially, most of the capacity augmentation that was to be done by the government has already been done. And there's enough capacity for 20% ethanol now. And roughly 67% of this year's ethanol has come from grain-based, and 33% has come from the sugarcane route. So effectively 2/3 and 1/3.
So there has been a lot of buzz around ethanol targets of India, especially considering the surge in profits that Nitin Gadkari's son has reported recently. What are your views on it, and where are we as a country heading towards achieving our ethanol target?
Well, I wouldn't like to comment on our honorable minister's personal affairs and companies. However, I do believe that they've simply undergone some mergers and they were already in the business for many, many decades of sugar processing, etc. That being said, I think the E20 or ethanol blended program, petrol program in India in general, is crucial to our country's progress. Now, there are many aspects to that. The first is self-reliance in energy. Now, increasingly, you are seeing global threats. So, we have to reduce our vulnerability to global threats. So, for example, we are importing almost 70-80% of our petroleum requirements. And it's coming from the lowest cost producing nations such as Russia and the Middle East. And most of these countries are under sanctions lists. So, the moment there is any international negotiation with India, people target us on that. So if we were not doing any ethanol at all, imagine we'd be importing even more petrol. So our reliance on these countries would be even higher and we'd be vulnerable to global threats. So self-reliance in energy is the first. Second is the rural and farm income. So all the benefits from ethanol are essentially going to the farmer. The first round of ethanol augmentation that happened was from 2018 to about 21, where the government focused on sugarcane based ethanol. And you saw farm incomes increase, you saw cane dues being paid on time by all sugar mills in UP and Maharashtra. And from 21, 22 onwards, they focused on grain based. Now, suddenly in the last 3 years, you're witnessing a revolution in maize. So, the maize farmer used to, the marginal farmers used to get maximum 11, 12 rupees per kg for their maize. Now they're getting almost 22, 23 rupees, which is at MSP. So, this is a huge revolution which has happened in India. Similarly, all these manufacturing facilities are in rural areas, close to the farms, generating huge amount of jobs in the rural areas. So if you look at recent Nielsen data as well, it says that there's a huge upsurge in demand in premium products from rural areas. So that's primarily because rural incomes are going up. Now, these are the first two, and the third is savings on pollution. So ethanol produces much lesser tailpipe emissions than petrol, and it's a direct substitute, so why not do it? But I think overall, if you look at the global theme, most countries are heading towards biofuels. We are only talking about ethanol, but most countries are talking about ethanol, they're talking about biodiesel, they're talking about solar, wind energy. So if you look at renewable energy in general, this is a global theme. There are ESG norms for companies, and in terms of biofuel mandates, if you look at ethanol itself, Brazil has mandated now minimum E30 blend, and then they have something called flex fuel engines. So 99% of the cars sold in Brazil last year were flex fuel engines, which means you can put from 0% to 100% ethanol in any ratio. And a combination of E30 and E100, the average blend in Brazil last year was 47% of ethanol. Similarly, the US has ethanol blends from 18% to 25% depend on state to state. So there is a state regulation. Now this is ethanol. Now look at and basically ethanol is being used in countries which are surplus in grain or sugar. Now countries which are surplus in edible oil, like Indonesia and Malaysia, have very vast quantities of palm oil. They are doing biodiesel. So Indonesia has got a B40 mandate. So 40% of their diesel is biodiesel. And Malaysia, for example, has a B20 mandate and to go up to B30 by 2030. So most countries with surpluses are converting their surpluses into biofuels.
90% of the palm trees in the world are in Indonesia and Malaysia. Now they are reducing the supply because of their biofuel.
And very often, you find non-tariff barriers created by the West, even for these countries. For example, Indonesia and Malaysia were exporting huge quantities of palm oil to Europe. Now Europe first, put some tariffs. Then they lost at WTO. And then the EU decided to have a deforestation non-tariff barrier against Indonesia and Malaysia. So that's how the story unfolds. And in terms of India, even for India, we are hugely surplus in sugar as well as grains. So India, even for grain, has 25 to 30 million surplus in grains.
So all type of grains can be used to manufacture ethanol?
Yes, absolutely. All types of grains. However, the 2 or 3 grains that the government is focusing on primarily, one is damaged food grains. So when you process any grain, for example rice or maize, you get some damaged byproduct, which is a natural part of the process.
Is it similar to molasses and sugar?
Well, molasses is a byproduct. Okay. However, in terms of damaged food grain, that comes out like, for example, in paddy processing, you get, let's say, 60% full grain rice, and then you'll get 15-20% of broken grains as well. So broken rice is one example. Similarly, then the second feedstock is the surplus rice that FCI has, and that starts rotting away in their godowns over many years. So that's another feedstock. And third, of course, is maize.
Okay. So has government achieved its E20 full capacity target?
More or less, I think towards the last couple of quarters of this sugar year, which is the ESY, they're close to about 19.5% blending. However, there's a huge growth in petrol demand. So this year, I believe, on a run rate basis, India's petrol consumption has grown by almost 7%.
Wow.
So next year's ethanol blending target will have to go up by almost 7-8%, again creating a gap.
So what is the optimal blend, meaning the ratio in which ethanol and petrol should be mixed so that it does not reduce the efficiency of petrol?
Okay, that's an interesting question. So ideally, you would have a base blend for all cars, which could be E20 or E30. In the case of India, I believe our cars are already compatible with E20, but going forward, it could even be E30. So that would be the base product that you would get. And the second would be straight away go to flex fuel vehicles, which could take any ratio from 0 to 100% ethanol. And ideally, you would have an E100 or E85 for that. And flex fuel vehicles basically have the capability to detect the percentage of ethanol and tune the engine accordingly. And effectively what it does is, of course, ethanol has a lower calorific value than petrol by about 25 to 30%. But a calorific value is not the only determining factor in engine efficiency. So ethanol at the same time has a higher octane rating. So what it does is, it produces better engine strokes or torque, for example, and better conversion from thermal efficiency to mechanical, thermal energy to mechanical energy. So it compensates some of that shortfall in calorific value by better engine efficiency.
Okay. So since we are talking about the blended fuel and E20 and E30 and the government has already achieved it, why we as a consumers have not seen any decrease in the petrol prices?
That's a good question. Well, one is, as we all know, that petrol is very heavily taxed in India. And ethanol attracts only 5% GST, whereas there's central excise and state VAT on petrol. So these are policy matters which only the government can answer. Secondly, while doing capacity augmentation in any sector, in the first few years, the government gives attractive prices to give ROI to the investors, people who have invested in these manufacturing facilities. And over the years, you see tapering off of prices. So same thing happened in, for example, cogeneration power plants in sugar mills. They started with 6-7 rupees per unit, and today they are only paying 1.2 rupees a unit of electricity generated by cogeneration plants. So you can say the same phasing happening with ethanol, and eventually in the long term, there are going to be very large gains for the country.
Okay, sir, I think we are done with the ethanol segment. I would like to move to your traditional business, that is olive oil, refined oil. So we have been witnessing a lot of flood in northern India. Does it impact in the coming quarters?
Not really. We are not directly affected. We are not in these areas, geographical areas, firstly. Secondly, even these floods, while you see them in media and it is very unfortunate, but in terms of a large landmass, it affects a very small area percentage in that sense.
Got it. So people are becoming increasingly health conscious. We have seen this concept of usage of cold pressed oils coming up, especially in Gen Zs. Even I told my mom that let's start using cold pressed oils because hot pressed oils are not good for health. First, what is the difference between hot pressed oil and cold pressed oil?
Well, essentially you have cold pressed oils and you have refined oils. There wouldn't really be anything called hot pressed oils, but so cold pressed oils are traditional. In India, we've always had them. For example, kachi ghani mustard oil. That is also a cold pressed oil. We have groundnut oil, which is a cold pressed oil. And then refined oils are like your soybean oil, sunflower oil, rice.
Is the manufacturing process different for these two?
Yes, of course. The cold pressed oil we expel by mechanical expelling. We simply crush the seeds and have cold jackets so that it retains the flavor of the oil. And secondly, refined oils are basically they undergo a refining process. But unfortunately, it's got a bad name. But actually, what it really entails is removal of impurities from these oils. It's the same oil that's been expelled mechanically, and then we remove certain impurities such as gums and waxes and fatty acid profiles to make it a refined oil.
So, coming to palm oil and rice bran oil, people often associate rice bran oil with refined oil and then ultimately comparing it to palm oil. Is rice bran oil a healthier alternative to palm oil?
Yes, absolutely. Rice bran oil has a very good fatty acid profile. Number one. Number two, it has a very, very high quantity of an antioxidant called oryzanol. And it has over 10,000 ppm, which is more than 1% of the oil. So imagine having 1% of an oil as an antioxidant. So I think it's really a wonder oil.
So, are you planning to introduce cold pressed oils?
Yes, in the coming quarter, we're looking at introducing two to start with. So we have cold pressed groundnut oil and cold pressed mustard oil coming out. And then we'll see in future what else.
So recently, I watched an Instagram reel of a very famous chef. So she ranked top 5 worst oils, starting with top 5 worst cooking oils, starting with palm oil, corn oil, blended oil, and then there was sunflower oil. And on the 5th number, there was rice bran oil, because she gave the reasoning that there's a use of hexane. But upon doing further research, I got to know that hexane evaporates while refining the rice bran oil. So it's misinformation. So do you think there is a lot of misinformation, especially from the experts, in the name of health consciousness or health freakness?
Well, first of all, we're talking about Instagram experts. So we need to check the legitimacy of these experts to start with. Secondly, you rightly said that there's a lot of misinformation. If you look at US and Europe, for example, 99.99% of these markets are refined oil consuming markets. They don't have traditional oils in India like mustard oil or groundnut oil.
Seed oils too.
In fact, if you look up online, you will find that the US, EU, and Canada have banned mustard oil for edible consumption.
Why?
They believe they have done studies and they found that it creates heart lesions in human beings. And this has been banned for many decades now. So mustard oil, which is exported to these markets for Indians, is actually sold as a massage oil or a hair oil. And then people buy it from supermarkets and they use it for whatever they want.
So coming to some straight facts, India's per capita oil consumption is 19 kg per annum, whereas it was 13 kg per annum 10 to 15 years ago. Isn't it counterintuitive to the fact that India is growing health conscious?
Well, I mean, the global average is 45 and apparently the American average is 65. So we are still lagging far behind. That being said, I think in India, we have two Indias, right? We have the urban, sedentary India, and then we have a very active rural India. So it's very hard to compare. It's not an apple-to-apple comparison. But at 19, we are still very, very low in global terms.
So also, what do you mean by you are the only player manufacturing multi-source olive oil in India?
Correct. So firstly, we are the only ones who process olive oil in India. And secondly, our brand is the only brand to have a blend with olive oil in India.
Blend meaning?
So we have a blend with olive and rice bran oil, and which we believe, based on some research, is actually the healthiest combination you can get.
Okay. When I was researching about your company, I got to know, not about your company, but generally in the industry, I got to know that there are some local brands which are selling olive oil at the same premium pricing. But if you look at the label, it would say 98% refined olive oil, whereas only 2% of extra virgin olive oil. So since you are the expert in this industry, what labels should consumers look at while making a purchase of this olive oil?
Well, this goes back to your question on cold pressed oils. So essentially, we believe cold pressed oils, in the case of olive oil, it's extra virgin olive oil, are primarily for taste. Like even mustard oil or groundnut oil, you should use them for flavor. Because the moment you heat it, you lose its antioxidant properties and some of the flavor. Mustard oil has a high pungency, so you don't lose all of it. But in the case of olive oil, you lose most of the flavor, because all the phytosterols and nutrients will evaporate at, let's say, cooking temperature, like 180 degrees or 200 degrees. So for cooking, actually, you should be using refined oils. So similarly, for olive oil, you have a cold application oil, which is extra virgin olive oil, and then you have a refined olive oil for cooking applications.
Okay. So 20, if I were to talk about the time 10 to 15 years back, companies like yours used to boast about the distributor network you have, retail network you have, or the placement of your brand in certain shops. But e-commerce and quick commerce has entirely changed this brand, especially with the advent of Zepto, Instagram, or Blinkit. So, how do you think are the dynamics changing in this industry, especially in FMCG products?
Sure. I mean, of course, quick commerce is more of an urban phenomena, and it's the reality. It's here to stay. In fact, it's growing very, very fast. And fortunately, we've been early movers in this. And in Q-commerce, we are almost number one in most of the subcategories that we operate in, and we have very good relationships with all these Q-com partners. And while distribution is still relevant for like non-urban, tier 2, tier 3 towns, it is similarly relevant even for Q-com, because so the rules of the game change. Instead of on-shelf placement and a number of outlets that you go to, now it's become more about your ranking on the platform, etc. So the rules change, but the basics remain the same.
So, in case of raw material fluctuations, how long does it take you to pass down the cost to the customers?
Well, for most of our products, it's immediate within a month or so, and of course, for commodity products, it's immediate.
And raw material remains a challenge, especially in the agri business. So, what do you have to say about your inventory losses in bulk division, especially in last financial year, I think?
Correct. So we did have a lot of inventory losses close to about 24 months ago, and that was based on the high inventory we were carrying in that particular year, and that was followed by COVID and the Russia-Ukraine situation, where we saw prices surge by almost 60-70%, and then the Indian government cutting import duties by 40%. So it was a huge curve for us. And how we've addressed it is, in future, if you look at our March 25 balance sheet, now we've really worked on reducing inventories and working on low inventories. So even if you look at our March 25 number, the inventories are very low.
Okay, so your debt to equity ratio also remains a concern. So are you optimizing your capital structure to reduce this debt to equity ratio to make the company more attractive to retail investors?
Well, prior to the ethanol project, we had practically zero debt. So we were a debt-free company. We had some working capital limits only for working capital, but we were a net debt-free company. And only for ethanol, we've taken up a term loan.
Do you see it reducing the ratio?
Yeah, of course. So there are two aspects to that. One is we always have the option to raise capital and pay some of that debt. However, we've got that debt at about 4.5% interest. So it is very, very low cost, and it is very strategic in nature, and it is also backed by companies' assets more than 100%. So we are in a comfortable position.
So last question, where do you see the Modi Naturals Limited going, let's say 5 years down the line?
Well, I can't really give you a number per se, but the way we visualize it is that we scale up our ethanol business in the next year or so rapidly, which is already underway. And we've done some amount of innovation in our byproducts in the protein ingredients space, where we are generating very good revenue as well as realization per kg, which is superior to the rest of the industry. And then using these ethanol cash flows to fund and to scale up our consumer business. So ideally, that's the way we would see ourselves in 5 years from now, where the consumer business is fairly scaled up, backed up by the cash flows from ethanol.
So last question, what have been the risks and learnings that have helped you attain the success at Modi Naturals Limited?
Well, an entrepreneur obviously faces significant risks, financial and emotional. Financial is basically all our assets and capital is tied up with the company, either in the form of investments or collaterals. So success of the company or failure of the company all rests with us. And lessons would be, I think there has to be a relentless work ethic if you want success at this level. And of course, it has a toll on emotional as well as there are cases where we see burnouts. We have to work very hard. But the other lesson is, of course, teamwork. I think building a good team and delegating work is very, very essential to success.
So, what is your promoter holding in the company as of now? It's 70%, right?
Currently, yeah, we're at about 69 point something.
So, do you plan on diluting your stake, be it for capital expansion or reducing your debt going forward in the future?
At the moment, there are no plans. I cannot say, but those options are all available to us, and we are aware of them. And when the time comes, we will let you know.
Thank you for joining us today.